Welcome to my webinar. My name is Eric Martineau, and there is my information. I've said for many years that private equity banking is like buying a toolkit. Now, if you're like me, you shouldn't go into Home Depot on Black Friday, but I did. And they had this tool set there on sale, and I bought the whole thing. Even though I didn't know how to use all the tools, I got the benefits of the entire kit. So when you get a high cash value policy, you get all of the benefits of the high cash value insurance policy. Let's walk through those. First of all, you get tax-free growth and tax-free use of your funds for life. You also get protection from creditors and lawsuits and also from bank failures. You also get liquid cash, and this is anytime access. In other words, this isn't like a 401k where you have to wait until you're 59 and a half to get at your money. You also have no fees or closing costs when you try to get some of that money back like you would if you went out to borrow money, say, from a bank. You get compounded interest both on your cash value and on your dividends. You also get guarantees that you won't get anywhere else, like from the unpredictable market, right, that goes up and down. You get those protections. You also get dual use. So you get both a savings account and a lending account simultaneously, and the savings side is not reduced when you try to get back at your money. You also get to work with some of the most stable financial organizations in the world. Privately, well, not I don't know if privately held is the proper term, but they're mutually owned insurance companies. So although they are for profit, they're owned by us, the policy holders. There's no stockholders. So very stable companies that have been around for over 100 years. Every once in a while, I'll have somebody say to me, Eric, look, I want all those benefits you just talked about. I just don't want to have to pay for the insurance part, right? Well, I look at it this way. That's like buying that entire rigid kit and getting this tool that you've never used before. You have no idea how to use it. And so you just go up to the cashier and you say, you know what? I don't know what this thing is, but I don't need it. So let's just take it out of the kit and reduce the price even more. Doesn't work that way. But if you are saying, you know what, I would like all those benefits that we just mentioned, but I don't want to have to pay for the insurance part, you're not the only person that's ever done that. So let's go through some recent history about insurance. There have been a lot of people with money that did not want to pay taxes, let's say, on that money. And so back in the early 80s, there were a lot of rich people, especially in the oil world, that said, you know what, here's I got an idea. Let's house our money around an insurance framework, and we'll get all those benefits that we just talked about without having to buy all the insurance. And by the way, these were called single premium life insurance policies. In other words, they bought just a little bit of insurance and a whole lot of cash value, and then they got all those benefits that we just got through talking about, right? They had a bank account that they could use anytime they wanted. It was tax-free growth, all those things that we just talked about. Well, what do you think the IRS did? The IRS looked at that and they said, nah, that sounds more like a investment than it does an insurance policy. So in 1984, after hundreds of years of having insurance, the IRS finally defined what they call a legitimate life insurance contract. Okay? Now, the whole point of this was to determine whether your life insurance policy was really a life insurance policy or an investment. That's what they were trying to figure out. Why? Again, this is the IRS doing it, so that they could figure out whether or not this was going to be tax-free or taxable. So in 1984 and then again in 1988, they put forth some rules that are called the MEC rules. You don't have to memorize that term MEC. It means modified endowment contract. But for layman's terms, let's just say taxable. So if you have an insurance policy that is a MEC, in the IRS's view, this is really an investment or a taxable entity. And that's what my job as an insurance agent is to make sure that your policy is not a MEC or taxable, so that you do get all those tax-free benefits for life and the IRS doesn't come back and charge you. Now, there's basically three tests. I'm not going to go into the technical details of them, but let's just say one of those tests is this 7-year pay test. What that means is the IRS is going to be watching your policy for at least 7 years. Again, this is not a get-rich-quick scheme, right? The IRS is going to be looking at this thing for at least 7 years to see if it waddles and quacks like an insurance policy or it waddles and quacks like an investment. And if it begins to waddle and quack like an investment, guess what? They're going to tax you on it. Okay? So you got a 7-year test that the IRS is going to watch this thing. Another thing that they're looking at are some ratios. One is the amount of cash value to the amount of premiums. In other words, your cash value cannot exceed the amount of premiums you've put in for, you guessed it, at least 7 years. Okay, so after 7 years, yes, you can have more cash value in your policy than premiums you've put in. But for the first 7 years, the IRS says, nah, that looks more like an investment if that crosses over before we get to 7 years. So it doesn't matter what insurance company you get with, they're not going to give you a better deal. They can't. It cannot cross until after 7 years, the amount of cash value versus premiums. And then the other thing they're looking at is the amount of cash value you have as a ratio to your death benefit. And this one, by the way, has to keep growing for the rest of your life. In other words, if in year 10 you put $1,000 into cash value, guess what? They're going to have to give you $2,000 or $3,000. I don't know the exact number, but they're going to have to give you $2,000 or $3,000 in death benefit because they have to keep those ratios working throughout the rest of your life. Okay? So to say that you don't want the death benefit it's kind of like saying, oh, I don't know. It kind of be like saying, you know what? I want my employer to be able to match my 401k income. I want my employer to be able to match that, but I don't want to have to wait until I'm 59 and a half to get at that money. It doesn't work that way, right? This is an IRS guideline. And so all insurance companies have to abide by this now. They can't just come up with this great little thing where you buy a little bit of death benefit and a ton of cash value, which is what they were doing before 1984. All right. Having said that, a friend of mine came to me the other day, and he's one of my clients. He's been with me for 2 years, and he said, Eric, but I don't need the death benefit. And I knew this, right? I got the policy for him, and I knew at the time that he was single. He's about my age, and he doesn't have a wife. He doesn't have any kids. You know, I mean, what's he going to do with that death benefit? At the end of his life, don't get me wrong. I mean, I'm sure he cares about giving that money to a charity or giving it to one of his nieces and nephews, but, you know, he really doesn't need the death benefit. And I knew that. And so when he said that, I had to ask myself, Eric, did you really get him a policy where he got the entire toolkit, but he's never going to use one of those tools? At least he doesn't care. Well, I guess you could argue none of us are going to use the death benefit. We're going to be gone. But, you know, there's some significant people in your life, wife, husband, children, you know, etc., that you do care about, right? But he didn't have that. And so I had to ask myself this. Well, he and I got on the phone and we walked through his policy. Now, I give another presentation with a CPA, and we talk about how you should structure your insurance policy. And so I'm just kind of using that other slide, but there are 3 parts to an insurance policy. There's the individual's body that's being insured, right? So the husband, the wife, the kids, whoever, a body has to be insured. And then you've got another component of the insurance policy, which is the policy owner. And this is the person that pays the premiums and has access to the cash value. And we argue at times that, and it could be, you know, the individual can have that money or the policy can be owned by, say, an LLC. I'm going to argue that probably one of the better places to put it is in the LLC. And then there's that third component, the component that my friend was saying he didn't want, which is the death benefit, right? So those are the 3 components. And to build your own private equity bank, I'm going to argue that that money should probably be inside of an LLC, but I do that in another in a different video. But when you've built up this bank then has the ability to make loans that the net cost of those policies or those loans is less than 1%. And so your private equity bank can now lend money back to individuals, whether that's you or your wife or your husband or your kids. We just gave a loan to one of our kids, right? And so you can make those loans to individuals, or your private equity bank can make loans to your business to expand the business, or it can go out and acquire more assets, which is usually where you would want to keep your assets is in an LLC. All right. I'm going to make an argument that probably is going to sound weird for an insurance salesperson, right? But we all need access to affordable cash much more than we need death benefit. Let me repeat that. During our lifetime, our need for affordable cash to fund our lifestyle is more important than the death benefit at the end of the road. Don't get me wrong, the death benefit's still cool at the end of the road if you want to build a legacy. But like my friend said, he doesn't have to build a legacy, he doesn't have anybody to build it with. So I would argue that yes, getting access to inexpensive money is more important than the death benefit in the long run. All right. So what I did is I sat down with this gentleman and we went through his policy, his actual policy. Now I've rounded up on the numbers to keep it even, but this is pretty close to where he was at. He currently has $74,000 in cash value. He's earning 4.76 on that money, and he's going to earn this year then $3,522. He has simultaneously taken out a loan from the insurance company for $69,500. Important point here. That $74,000 is all still there, and it's still all earning 4.76. He simultaneously has a loan for $69,500, and he's paying the insurance company in a separate account, if you will, 5.66% interest. So he's going to pay the insurance company this year $3,934. Two accounts, one positive, one negative, which means that his net interest rate is really only 0.9, not even 1%, right? I mean, think about that. Where can you get $69,000 and pay less than 1% to borrow it for an entire year? So his out-of-pocket cost, if you want to compare just those two to each other, is only $411. Okay. Now, I knew this gentleman because I helped him get the policy, and I knew what he had done with that money. So I asked him, did you really go spend that $69,500 on your credit cards? He said, yes. I said, so what were you paying on those cards? He said, about 29%. But I paid them off. That was his term. I paid off those credit cards. True. So he paid off credit cards where he would that year, no matter what, have paid to Chase or Wells Fargo or Bank of America or whoever else gave him his Visa, he would have paid $20,000 in interest. But he paid it off in his mind. Those were the words he kept using. But I paid off that loan. It's like I'm having to pay it off twice. Let me ask you, and I asked him this too. Did he really pay off that loan? No, he did not. What he did is he traded a loan where he was paying 29% for a loan where he's paying 5.6, which is being offset by earnings at 4.76. So the net effect is less than 1% for that money. But if you want to compare apples to apples, he traded a 29% loan for a 5.6% loan. Because obviously this money's going to grow whether he borrows it or not. Okay, let's make that clear too. All right, let's go to the next one. He says to me, yeah, Eric, okay, I get that, but I'm still having to buy insurance, and I don't need the death benefit because I don't have anybody to leave it to. And I said, okay, well, let's just call this your tax, your insurance tax. And let's bring up the concept then on cash return. This year, he's put in 36,000 in premium, and that 36,000 in premium is going to earn him $27,000. So what I would call his net cost of insurance is really 8,842 because there's still a negative there. And where's that money that's negative going? It's going to buy that death benefit he says he doesn't want to have to pay for. Understood? Okay. So if we add the 414 he's losing in interest, or sorry, the 411 that he's losing in interest, and we add that to the negative 8,842 that he's paying for the insurance, he's losing $9,253. Let's compare that to the 20,000 that he would be paying or that he would have been paying to Chase or Wells Fargo or whomever else he had borrowed that money from. You see the point? And so the difference there is $10,902. Now, where should he put that difference? In my mind, he still has the debt. Again, he said to me, well, I've paid it. Now I'm paying it off again. I've paid it off twice. No, he didn't pay it off the first time, did he? He just transferred it to something that's costing him less. Does he still need to pay it off? Yeah. And I think maybe that was part of his mental issue is he was saying, well, I've paid that off. No, he didn't pay off that money. What he did is he put money into a savings account that's earning for the rest of his life. He still needs to pay it off because he just traded it for a loan that's costing him 5.66 instead of 29. So I just got through saying that he doesn't have to pay that 10,900 back, but he should. Okay, where did I come up with that crazy number? Let me show you where that came from. I just went out to Experian and I went to their credit card payoff calculator, and there's a lot of these out there, and I typed in 69,500 at 29%, and it filled in the blank and it told me that the minimum payment that the credit card companies would want on that is $2,375. So then I hit calculate, and it takes me down here, and it says that this loan is going to be paid off in 52 months, paying $2,375 a month, and he's going to end up paying in interest, check that out, $52,000 in interest is what he's going to have to pay there, right? Okay, so then I jump over here and I duplicate that tab again on their credit card payoff calculator. I put in 69,500 at 5.66%, which is what the insurance company is going to charge him. And I wanted to get to the same 4 years or 52 months, and I played around with it, and I got to the point at 1,500. So to pay it off in the same amount of time would take $1,500 instead of 2,375. Hit calculate, and you'll see it still says it's going to take 52 months to pay off. Look how much interest now he pays. 7,881 versus 52,666. Okay, which would you rather? 41% is going toward interest here, and over here using the insurance company, only 10% of it's going to interest. That doesn't take into account the savings portion. So again, Experian savings calculator, put down the $74,000, right, at 4.76% monthly, 4 years, hit calculate, and what do we get? His $74,000 over the next 4 years is going to grow by $15,486. Okay, so that's where I got those crazy numbers. All right, now back to this. Notice the payment here, $2,375 versus $1,500. So if I pull down a simple calculator, all right, so I pull out the simple calculator here, right? 2,375 minus, so that's the payment that he has to pay if he's paying back the Visa card, according to the Experian website, that's what the minimum payment would be, $2,375. So he's committed to that. But it says that if we're charging only 5.6% interest, he'd only have to pay $1,500. So if we say $1,500, now that leaves us $875 difference. Could he get away with just not pocketing that in his pocket? Yes, he could. But if he wants to get out of debt, I'm suggesting that he also make that extra $875 back up to the $2,375 a month so that it's paid down quicker. The idea is to get him out of debt, right? But if we multiply 875 times 12, we get 10,500. That's why I came up with that number right at about 10,900 to say he doesn't have to do this, but he should. So he should pay that back. And yes, it's the same amount of payments he would have been making if he was making the higher payment of interest at 29%. Hope that makes sense. So if he takes that difference there of $10,900 and he pays it that during the year against that loan, well, that's going to drop it down. So now let's go look at year 3. In year 3, he's still going to pay $36,000 in premium. Now, that 36 would be added to this 74 there, making it $100,000, right? But I've put it in light gray because I kind of want to continue this snapshot of the 74,000 that he currently has against the 69,500 that he currently owes the insurance company that he wiped out of a credit card. Okay, so yes, it would be added to it. Yes, that's the amount of interest that he would extra earn that year. I'm just not adding it in because I kind of want to keep this snapshot the same. So he still has $74,000 earning 4.76, or in other words, 3,522. Now let's say he did take that 10,000 or so dollars and he paid down on that note, and now that note to the insurance company is $59,000, and he's still paying 5.66 on that portion. That means this year he's going to pay $3,339 in interest, right, instead of what he would have been paying to the Visa company. So if we look at the two here, he's got a positive cash flow here of 3,522. He's got a negative cash flow here of 3,339. That gives him a positive overall of 182 bucks. But he still has to do what he said, pay for the insurance. So what's his net insurance cost? Well, this year his 36,000 in premium increases his cash value by 34,817. The net effect, well, his, as I would call it, this is my term, it's not an insurance term, but my term is his net cost of insurance that year, looking at cash on cash return, is a negative 1,183. So yes, he is paying for death benefit that he claims he doesn't need, which is fine, and his claims are accurate. And it is costing him 1,183. But look what's happened here. He now has a positive 182, a negative 1,183 for a negative $1,000, right? Versus, let's say he had just been making his normal payments on that Visa card, he'd now owe $68,000, paying 29%. So he would have increased, again, interest into that Visa or that group of Visa cards, because it was a group of cards, by 19,720 bucks. So once again, if we take that 1,100 that it's now costing him, that's his true cost, against the 19,700 it would have accumulated, that's a savings of 18,719 bucks. Now again, that's the savings. It's not money he got back in his pocket. That's his savings. So if he did take that savings and put it against that $59,000, he would reduce it to $40,000. Now, does he have that money to pay that year? No, probably not. But if he's reducing that amount of money that he does owe the insurance company, the Visa companies, that's still a real savings, right? It's not money he's actually put in his pocket. But if he takes that amount that he would have been trying to pay and he pays it against it, you see how he can pay this down a lot quicker? All right, let's go to year 4. Now again, his premium is still 36,000. He puts that in again. That's another 4.76%, another $1,700 a year that's going to grow the rest of his life at that point, right? But again, keeping that same snapshot of 74,000 when he began this thing, that's still 3,522. Let's say he did pay that money back against the loan that he saved. That's 40,000. Okay, so now he's only paying 2,264 for the interest uh, on the insurance loan. So now he's got a positive between just those two of 1,258. And what's his net insurance cost in year 4? Well, here we go. In year 4, he puts in 36,000 in premium, and he's got $35,906 in increase in his cash value. Therefore, the negative there is only $94. That's what the net cost of his insurance is. It's only $94, but he made a positive interest rate of 1,258. The net effect a positive 1,164. Again, if we assume he had just been making regular payments on that Visa card, it would now be down to 66,000. So this year, again, he would have received over $19,000 in interest, whereas he saved that, and the total net savings between those two, $20,000 again. Again, this is savings because he didn't have to pay that to these guys, right? It didn't rack up against him.
Let's keep in mind, he's no longer making a structured payment to the credit card company. Remember, his payment was $2,375. Right there. He no longer has it. And so this is probably another concept that is, how to put this, it's probably part of the reason why he was thinking he didn't have to make a payment, right? Or that he had paid it off. Remember, he kept saying, well, I've already paid that off. Well, he has. And what is the reminder every single month that you haven't paid off your credit card, right? Well, the credit card company sends you a bill every single month for $2,375. And what happens if you don't pay it? They kill your credit, right? And this guy with his job could not afford to have his credit trashed, right? So as soon as he paid off those credit cards, he no longer had an official payment of $2,375. Why is that? This is another blessing and a curse of an insurance loan. The good news is that your cash flow can go up by $2,375. Why? Because the insurance company, this is a non-structured loan. And for those that aren't in the mortgage industry, a structured loan is like a home loan or an auto loan or a credit card loan where once a month you have to make a payment. But an insurance company, again, back to that death benefit that he says he doesn't want, the death benefit is what allows the insurance company to not worry about whether you make a monthly payment. So the insurance company isn't sending him a bill every month for $2,375. They're not sending it for $1,500, right? They're not sending him a bill every month. And so in his mind, I'm sure, in most of our minds, is like, oh, well, out of sight, out of mind. I'm not getting a bill every month. I don't have to pay it, right? So if I say, well, does he have the money? Well, he sure did when he committed himself to the $69,500 on a credit card because they were going to bill him every single month. But with an insurance loan, they don't care because the death benefit, again, the thing he doesn't like, is going to cover that loan when he dies. So it is an eventuality that the insurance company isn't worried about. That's why it's a guaranteed to pay off. It's zero risk to the insurance company because whether he pays it back himself or whether the insured passes away and they subtract that $69,000 in debt from the death benefit, one way or another, that bill will be paid and the insurance company isn't worried about it. So two-edged sword, I guess, right? The monthly bill went away, but should he still be paying it? Absolutely.
But it's not like they put it back in his pocket. The 1,164, yes. But because he saved that 20,000 this year, that's just that much more, that extra 20 that he could be paying against that insurance loan. Again, I don't know how much of that 20,000 he'll be able to afford to put against it, but he would. But let's say he could put that whole 20 against it that year. Now he's down to $19,696. Is that cool or what? All right, let's move on to year 5, and I'm going to make this a lot quicker here. But this is where, again, his premium is $36,000, and it's going to grow. His cash value is going to grow by $37,048. In other words, a positive of $1,048. Remember that 7-year rule, though, right? His premiums for 7 years have to be greater than his cash value. So even though the cash value grew by a little bit more this year, remember it was negative for the first 4 years, therefore it still isn't a total cash value that's larger than the total premium. It can't until year 7. But if we jump out to year 10, those shackles are off, and now his $36,000 would grow by $40,000. The IRS doesn't care now that his cash value is growing at a larger rate than his premium because we've gone past that 7-year threshold. And he made an extra $4,490. In year 20, his $36,000 grows by 50,782. In other words, it grows by 14,782. Year 21, and this is an important one. Again, this is this guy's real policy. And year 21, he quits making any payments into this thing. Go try that with a IUL, or a term policy, right? He never makes any more payments. Now he's older, right? He needs the death benefit, but he puts in 0 in premium, and look what that happens in year 21. His cash value grows by $21,000, even though he didn't put a single penny in. And remember what I said, those ratios of cash value to death benefit, they have to be at a ratio that the IRS says is still there throughout the life of his policy. So if his cash value grows by $21,000, guess what has to happen to his death benefit? Probably 2x that amount by then. So his cash value is growing, and so is his death benefit for the rest of his life without ever making another payment. I truly believe that high cash value insurance is the best private equity banking world you can play in. That's why I call it private equity banking. Having a private equity bank is more important in my mind than having the death benefit. That's why it's called private equity banking. I really do believe that the toolkit I call private equity banking, the banking portion of it is more important than the death benefit portion of it. I truly do. So if you've liked this content, like the button down there, subscribe to my channel. But more than anything, I'm sure someone within the sound of my voice knows somebody that needs to do just what I showed that friend doing, and paying off his 29% credit cards with something at 5.66 with a net effect of less than 1%. So share this with somebody. Send this video over to somebody that you know it can help. Look forward to hearing from you. Oh, and then get right back with me. There it is, privateequitybanking.com/calendar. Set up some time with me. Text me, give me a call, whatever. Get with me, and I'll help you out, or your friends and family.